If you think silver hasn't moved, you're already late. Price looks calm, headlines boring, but something just changed underneath. JPMorgan's accumulated over 130 million ounces of physical silver over 15 years while staying net short on paper. China just tightened export controls on critical metals. Industrial demand, solar panels, EVs, data centers hit multi-year highs. Meanwhile, COMEX registered inventories dropped from mid-80 million ounces to under 50 million in 18 months. And the price? Flat. That's not stability. That's friction. If you're holding metals, watching commodities, or ignoring both completely, this pattern matters. Because what you're seeing isn't a sleepy market. It's the setup before physical supply and paper pricing finally disconnect. If you're watching now, you're ahead of the crowd that only reacts to candles. Your job isn't to predict timing. It's to understand structure. And I'm about to show you two patterns that repeat before markets snap. Quick thing, hit subscribe if this kind of breakdown helps. We don't trade hype here, we watch pressure. Drop a lightning bolt in the comments if you track metals. I want to know who's paying attention. Here's what just shifted. For over a decade, JPMorgan built the largest private silver stockpile in modern history. Quietly, while futures positioning stayed short. While mainstream analysts called silver dead money. Now, industrial offtake is grinding higher. Solar installations globally are running roughly 4 times levels from 5 years ago. Each gigawatt needs silver. EVs need silver. AI server farms need silver for thermal management and circuit boards. China, the world's largest refiner, announced export restrictions on antimony, gallium, and graphite. Silver wasn't named, but the message landed. Strategic metals are now policy tools. And here's the hidden layer nobody's talking about. COMEX warehouse stocks are reclassifying. Registered drops. Eligible rises. Looks like shuffling. But registered is what's available for delivery. Eligible is just stored there. The pool that matters is shrinking. Lease rates, what it costs to borrow physical silver for short periods, crept higher. Still low historically, but rising when inventories should make them fall. Physical premiums at dealers? Sticky. Won't compress even when spot drifts sideways. Think about that. Price is the headline. Friction is the story. Let me show you the first mechanism. I call it the liquidity-to-scarcity flip. Here's how it works. Paper markets, futures, ETFs, derivatives, they keep liquidity flowing, smooth, deep. You can trade size without moving price. Looks healthy. But physical supply is different. Physical drains slowly, warehouse by warehouse, dealer by dealer, mint by mint. Imagine a water tank with a wide pipe at the top and a narrow drain at the bottom. The top pipe keeps flowing. Everyone sees the flow. But the tank is empty and through the bottom drain nobody's watching. That's the flip. Paper liquidity stays open while physical supply silently exits the system. Price discovery lags because the paper market is bigger, louder, more liquid, until the tank runs low enough that someone tries to drain it fast. Then the valve can't keep up. Not telling you silver does this next week. Showing you the pattern so you recognize it when stress builds. Right now, COMEX futures trade smoothly. Open interest is stable. Spreads tight. No delivery failures. No panic. But registered inventories keep grinding lower. Physical premiums won't fall. Lease rates edge higher instead of lower. Mints report multi-week delays that didn't exist 2 years ago. The paper market says everything's fine. The physical market whispers something else. Why does this pattern repeat? Because large players always secure supply first. then let price adjust later. They don't announce it. They don't bid price up and draw attention. They accumulate quietly while liquidity is deep and sellers are bored. By the time the market reprices, the metal is already gone. This is exactly how energy markets behaved before shortages in the mid-2000s and again in 2021. Natural gas futures stayed calm while pipeline capacity tightened and storage drew down. Then winter hit Europe and price ripped overnight. Could silver reverse? Absolutely. New supply could flood in. Industrial demand could crater. China could dump reserves. Your job isn't to predict. It's to watch the structure. Second pattern, the dealer inventory trap. Market makers, bullion banks, trading desks, large dealers, they exist to provide liquidity. They buy from sellers, sell to buyers, collect the spread, but they're also participants, and when they see structural tightness coming, they shift from neutral to long, not by announcement, by behavior. Here's how it shows up. Premiums stay elevated even when spot drifts. Dealers aren't competing prices down because they're not eager to sell. Delivery times stretch. Minimum order sizes creep higher. Promotional discounts vanish. Meanwhile, retail gets discouraged. Headlines stay boring. Price goes sideways for months. Volatility dies. Traders move to crypto or tech stocks. Stackers get bored and stop buying. Online forums quiet down. That's not accident. That's the setup. Imagine you're a dealer sitting on 50,000 ounces. You see industrial demand rising. You see Chinese export restrictions tightening. You see COMEX inventories dropping while your cost to source new metal is grinding higher. Do you blast emails to every retail buyer saying, "Buy now, shortage coming"? No. You stay quiet. You let the market stay boring. You let weak hands sell into your bid. You let retail drift away. Then when the squeeze comes and price finally moves, your inventory is already positioned. By the time the headlines change, the metal is already gone. Not saying every dealer does this, not saying it's coordinated, saying this is how inventory positioning works when smart money sees friction ahead. Circle this. Discouragement is part of the accumulation phase. The trap works because retail buys excitement and sells boredom. Institutions do the opposite. They buy when nobody cares. They sell when everyone's convinced. And right now, silver feels boring. Lease rates rising while inventories drop should create urgency. It doesn't, because the paper market still looks calm and headlines don't scream. That divergence is the trap. Think about what happens if industrial demand spikes before inventories rebuild. If solar installations accelerate faster than forecasts. If one major electronics manufacturer shifts orders forward to secure supply. Suddenly, everyone who needs physical metal is bidding for the same shrinking pool. The dealers who accumulated early have the metal. The buyers who waited for confirmation are fighting over scraps at higher prices. Could this take years to play out? Sure. Could inventories rebuild and make this whole setup irrelevant? Absolutely. But here's what you need to sit with. The real question isn't will silver go up. It's who already positioned for when it does. If you're reacting to price, you're behind. If you're watching flows, availability, dealer behavior, lease rates, you're seeing the pressure before it converts to price. That's not a guarantee. It's structure. And structure repeats. Let me walk through 3 scenarios, not predictions, just different paths this plays out. Base case, slow grind. Industrial demand stays elevated but doesn't spike. China's export restrictions tighten, but gradually. COMEX inventories stabilize around current levels. Physical premiums stay sticky, but manageable. Price drifts higher over quarters, not weeks. Volatility stays compressed. Retail stays bored. No headlines, no mania. Winners? Patient holders who bought before friction became obvious. People who understand that boring often means accumulation, not death. Losers? Traders chasing momentum. People waiting for confirmation. Stress case, export shock, or industrial surge. Maybe China broadens restrictions. Maybe solar installations blow past forecasts. Maybe one large manufacturer panic buys to secure supply. COMEX registered inventories drop below 30 million ounces. Lease rates spike. Physical premiums explode. Delivery delays stretch to months. Price moves violently because the physical market can't absorb sudden demand without repricing. Winners? Anyone holding physical before the move. People who paid attention to inventory signals, not price signals. Losers? Paper traders caught short. Retail buyers trying to chase after premiums already doubled. Relief case. Paper liquidity masks tightness longer. Maybe COMEX players shuffle more eligible into registered. Maybe new mine supply surprises. Maybe industrial demand softens temporarily. Friction builds but stays hidden. Price stays range-bound for another year or more. Winners? People who stay patient and keep watching structure. Accumulators who don't need immediate validation. Losers? Impatient holders who sell because nothing's happening. People who confuse temporary relief with permanent resolution. No guarantees. Markets don't announce which path they're taking. But here's what I'm tracking. Signal 1. COMEX registered versus eligible changes daily. Normal behavior? Registered fluctuates but averages stable. Eligible and registered move in tandem. Stress behavior? Registered grinds lower while eligible stays flat or rises. Reclassification without replenishment. What it means. Available supply shrinking even though total warehouse stocks look okay. Signal 2. Silver lease rates and forward curve. Normal? Lease rates near zero or slightly negative. Flat forward curve. Stress? Lease rates rising. Forward curve inverts. Near term tighter than long term. Backwardation. What it means. Physical metal more valuable now than later. Spot scarcity building. Signal 3. Physical premiums versus spot divergence. Normal. Premiums compress when spot drifts sideways. Dealers compete for buyers. Stress? Premiums stay elevated or rise even when spot is flat. Dealers reluctant to sell. What it means. Wholesale supply tighter than futures market suggests. Signal 4. China export headlines tied to industrial metals. Normal, quiet. Routine trade flows, stress. Policy announcements around strategic metals. Export licensing, quotas. What it means. Supply chains reprioritizing. Downstream scramble incoming. Signal 5. JPM-aligned futures positioning shifts. Normal. Net short or neutral in COT data. Providing liquidity. Stress? Net short position shrinks or flips long. Inventory accumulation visible. What it means? Major player repositioning before structural change. Not telling you to trade these signals. Showing you what to watch so you understand pressure before it becomes price. If you're a trader, respect volatility and size accordingly. If you're a holder, accept pullbacks without panic. If you're observing, know that recognition comes before opportunity, not after. Here's my risk cluster, not advice. Just how I think about hedges as awareness tools. Watch gold-silver ratio compression. Watch copper for industrial demand confirmation. Watch energy for inflation proxy. Watch dollar strength for commodity headwinds. Watch real yields for opportunity cost shifts. Watch Bitcoin for risk-on, risk-off sentiment. None of these tell you what silver does next week. They tell you whether the environment supports stress or relief. Your job is context, not prediction. Here's what matters. Markets don't announce transfers of wealth. They whisper first. Friction before price. Structure before headlines. Big players buy quietly. Loud markets come later. If you're watching flows instead of headlines, you're already in the informed group. The group that doesn't wait for confirmation. The group that understands accumulation looks boring and distribution looks exciting. Liquidity hides scarcity until it can't. By the time silver feels obvious, it's unavailable. Not saying it happens tomorrow. Not saying it's guaranteed. Saying the pattern is forming and you're watching it develop instead of reacting after it's already moved. That puts you ahead. If you stay disciplined, watch signals instead of price, and ignore the noise when nothing's happening, you put yourself in the group that doesn't get shaken out right before the move. 2 asks. 1. Comment below, what signal do you watch? Lease rates? Premiums? Inventories? Something else? I want to hear what you're tracking. 2. Share this with one person who holds metals or watches commodities. Not 10 people. 1. Someone who'd benefit from understanding structure instead of chasing candles. Hit subscribe if breakdowns like this help you think clearly. We're building a community that watches pressure, not headlines. Links to COMEX data, COT reports, and lease rate tracking in the description. Final thought. Price is the last thing to move. The story is already being written in warehouse drawdowns, lease rate creeps, dealer behavior, and industrial offtake. You're watching it now. Before the crowd. Before the headlines. Before the obvious trade becomes the crowded trade, that's the edge. Stay sharp.